Well, welcome back to the Central Arizona VITA Network's tax law training for the 2024 tax year. In our last session, 4B, we finished our discussion on credits with the discussion of non-refundable credits. In this session, we're going to discuss itemized deductions, the Affordable Care Act, other taxes that you might come across, in miscellaneous forms. So let's get started. So this would be session 5 in our live face-to-face courses here. And as I said, we'll save the reviewing the homework for the next session after we've covered these itemized deductions and Affordable Care Act, things like that. But we'll cover itemized deductions. Briefly, payments and estimates, this is fairly easy. That will be under other taxes and miscellaneous forms. We will talk about the Affordable Care Act because you will see that, and that's part of your test questions too, that you'll do it. And then at the beginning of the next session, we'll kind of review the rest of the test questions. So I've briefly discussed this before when we started talking about who must file a return. You know, you have a choice of either taking the standard deduction or itemized deductions. Standard deduction is a set amount for, depending on your filing status, if you're single, married, head of household, or whatever. It's a set amount. They'll give you, you don't have to prove anything or provide any documentations. That's just if you're breathing air. The IRS recognizes you have deductions like charitable contributions and you pay taxes, so they just give you a set amount. That makes it very easy. Now, if you can itemize deductions and you can prove you have more of those deductions like medical expenses and charitable contributions and taxes, then you can take the larger of the deduction, and that's when we say you itemize deductions on Schedule A. By the way, TaxSlayer will automatically calculate this for you. And you should itemize if the total of deductions are higher than the standard deduction amount. If you are doing married filing separate, which we can't do that, but just sometimes these folks will come in and they think they'll get a big tax benefit if, say, one taxpayer can itemize deductions and then the other one takes the standard deduction. And IRS says, no, 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 no. If you do married filing separate, if one itemizes, then the other has to itemize. So they don't let you kind of play tricks with it that way. This is very important, is that you could take the standard deduction on your federal return and itemize on your state return. Now, why would you want to do that? In Arizona, well, we're going to find out in just a few minutes that for the federal itemized deductions, there's a limit on like medical expenses that you can take. Arizona doesn't have a limit on medical expenses. So you might find that for Arizona, your itemized deductions come to more than your standard deduction. So that would be a place where you might take the standard deduction on the federal, but itemize on your state, okay? If you're not sure if the client will be able to itemize, go ahead and just input all the itemized deductions. And sometimes some taxpayers, they're just adamant that they should itemize their deductions, and it's just best not to argue with them. It doesn't take that long to input them, and then TaxSlayer will automatically calculate it. You know, and sometimes they'll get really adamant, and you'll say, okay, and you input it in, and you can show them, here's your itemized deductions. Now, the standard deduction was more, but if you want, we can take your itemized deductions, and usually at that point, they realize, oh, yeah, okay, I'll take the standard deduction. But then again, as I said, sometimes on the state return, and that would be another good reason for just inputting everything if you're not sure, okay? Here's kind of a tip. I've said this in earlier videos, and since the Tax Cut and Jobs Act, when the standard deduction was basically doubled, I think the figure is like 95% of tax returns take the standard deduction. We just don't see very many itemized deductions anymore. But somebody sits down with you, and here I will tell you another thing. It is almost never that somebody will itemize deductions unless they have mortgage interest. They own a home and they're paying on a loan. That's usually the largest standard deduction. Or they have huge medical expenses that weren't covered by insurance. Because if it's covered by insurance, you can't deduct it. The insurance company paid for it. Now, they're always going to have some kind of, medical expenses. They've got co-pays and deductibles and things that weren't covered by insurance. But usually that 7.5% threshold, they've got to get over 7.5% of their AGI. To give you just a quick example, let's say you've got a client with $50,000 of AGI. I mean, that's kind of typical for a VITA client coming in here. 7.5% of 50,000 is $3,750. So even if they've got medical expense, the first 3,750 doesn't even count for federal. It does count for state. Okay. Now think back to what our standard deductions were. They're what, like 14,000 single and 28,000 married filing jointly. You're going to need a lot of itemized deductions to get past that threshold. But again, if you're not sure, so if I get a client that comes in that's got mortgage interest and they've got some medical expenses, I just go ahead and input it just to make sure I'm not leaving something on the table for them. Yeah, sometimes the client kind of demands that. Don't argue with them. Just go ahead and put it in. It's usually 10, 15 minutes is all it's ever going to take you at most. Okay. So here are the standard deductions amount. If you're single or married filing separate, it's 14,600. Qualifying survivor spouse is 29,200, or if you're married filing jointly, it's basically double the single one. Head of household is like somewhere in between, $21,900. But there's additional amounts that get added to the standard deduction if you're 65 or older, or if you're blind. I've shown you in TaxSlayer, when you get to that first screen of inputting the information, there's all those check boxes down there. Be sure to look at that. And, sometimes it could be very obvious when somebody's blind, but then on the other hand, the medical definition of blind, um, it doesn't mean they can't see anything. It's just, I forget what the official designation is. But, if you see somebody that's here, that's with you, and they look like they're having trouble seeing, you might ask them, have you been to the doctor? Does the doctor say anything about the definition of your visual acuity? Or, you got to be a little careful about that. Usually these folks know, and they'll say, oh yeah, the doctor's told me I'm legally blind. And even though they might be able to see something with thick Coke bottle lenses and something, they may meet that definition of being legally blind, and you can get them a tax benefit for it. Okay. I've already mentioned this about the Arizona state tax returns, that um, you you can deduct all of the medical expenses. So if you're not sure, go ahead and put them all in, and then TaxSlayer will calculate what's best for them. Okay. Now, here's one more thing. You'll see this little asterisk down here. As I said, you're going to enter in everything here. If you're not sure, you enter it on the federal side, because that carries over to Arizona. Okay. We talked about last time about the Arizona tax credits, and I said this in the last session too. Be sure, even if they're not itemizing deductions, be sure to enter in all of the charitable contributions unless they're using it for the Arizona tax credit. Then you don't enter it on the federal side, because then you would be double dipping. But that's because even if they're not itemizing, they get that extra standard deduction on the Arizona return for 33% of their charitable contributions. Okay, so here's the TaxSlayer screen, and here's where you're going to get into to put in your itemized deductions. when I go into that screen, well, before we get into that screen and show you, let's kind of go through a couple of just mental exercises, if you will. Okay. So if you're single and the standard deduction is 14,600, but your itemized deductions are 15,759, which type of deduction would be best? I don't think you have to think real hard about this. Of course, itemized deductions. Okay. You're married, standard deduction is 29,200, but all your itemized deductions come to 24,500. Well, you want to then take the standard deduction. And as I said, TaxSlayer will calculate that. If you enter in the itemized deductions, it's going to take the larger of the two. Okay. Head of household is 21,900, but it says your itemized deductions come to 22,000. It's only $100 more, but yeah, you're going to still itemize deductions. Okay, let's talk about the itemized deductions. Okay. First of all, there's medical and dental expenses, but as I said earlier, only those that exceed 7.5% of your adjusted gross income. Second, you get to deduct taxes, the whole variety of taxes. Property tax, like real estate tax, so if you own a house, you can deduct those taxes. Vehicle license tax, this is a portion of your vehicle registration. We'll show you that in a minute. Maybe you bought a car or a boat. Well, most of our clients aren't buying boats, but they do buy cars, and you pay sales tax on that purchase. You get to deduct that too. There's a limit of that. This limit probably will never affect our clients, but you probably read about this in the news, that some of these states like California and New Jersey, they've got some pretty high property taxes, and a lot of folks, they get limited on how much they can deduct. Here's the big one, mortgage interest, and we're going to talk about some of the limits there. Most won't apply to our clients, but you should be aware of a couple of those limits. Then charitable contributions, and it says up to 60% of AGI. Now, hang on a second, especially for our clients, right? We're dealing with low income. They're not giving away over half of their income, but still, there's the law in place here for wealthy clients, the Bill Gates of the world that want to give away, 3/4 of their income. They put it in their private foundation, and IRS says, no, we'll let you give away 60%. Like I said, you're not going to run into that limitation with our clients. Here's the screen for itemized deductions, and we're going to talk about all of these: medical and dental expenses, taxes that you paid, mortgage interest, gifts to charity. Some of these things are no longer like unreimbursed employee business expenses. This is like, well, I'll give you a real good example, like during COVID when employees had to work from home. Did they have to buy things and stuff to be able to do their jobs? That would be an employee business expense. The Tax Cut and Jobs Act got rid of those. Okay, you can no longer deduct expenses if you're an employee, and even though you spend money so that you can do your job, if you cannot deduct it anymore. Now, that Tax Cut and Job Act will expire at the end of 2025, and who knows, maybe those will be back. Maybe that's why TaxSlayer still leaves this little link in here. I'm not sure. We had talked about gambling losses. Remember, I said in that case where somebody comes in with a bunch of gambling winnings, they get a W-2G, and most gamblers, I mean, the casinos wouldn't be in business if they were losing a lot of money. So a lot of gamblers have losses to offset those winnings, but you can only use those losses if you itemize deductions. And so down under here, you would go under miscellaneous deductions and do that. Okay, medical expenses. So these are expenses paid within the year. Now, be careful. I'm going to give you one exception. If you pay with a credit card, maybe you haven't paid off the credit card, but that still counts. You paid them within the year. Okay. And only those expenses that belong to the taxpayer, the spouse of the taxpayer, and the dependents listed on the return. Here would be an example. When I go into the screen, the TaxSlayer screen, it gives you a lot of varieties you can put into. Sometimes, the clients, they'll bring in a shoebox full of receipts. You've heard of that. And, we're usually trying to prepare a return in 1 hour. And if a client comes into me and we're going to itemize their deductions, we have little worksheets at our site about deductions, and I'll tell them to go sit in a corner and add them up and bring me back a schedule of what were your medical expenses, what were your prescriptions. You go add them together and do it. But if it's just a few, we'll put them in. If you can add them all together and you can put here like amounts paid to doctors or amounts paid to prescriptions. If for some reason you want to itemize it, you can click on these little three lines and it'll open up a screen where you can type in a month and you can put in an amount. And that would then do the math for you. It would add them all together if you wanted to type in all of those things. Here, the next couple screens will show you what that is. So when I click on those little three dots, it's going to give me an itemized list of amounts paid to doctors and dentists. And I can say, doctor bills for York and Cindy, put in that one and hit continue. Then I could add another one if I wanted to here. Here, see where they put in dentist bills. This is not really necessary. Only if you think that there's something strange or whatever that you want to document on the return in case, they come back or question something, then you could use that, okay? Taxes. Taxes you paid are deductible, okay? First of all, here's an example of what they call personal property taxes, okay? And in Arizona, the big thing is on their Arizona vehicle registration, you can see all of these fees that are on here, most of which are not deductible, but the big one will be vehicle license tax. That's the deductible portion that we can put in and deduct on Schedule A. You've seen this before, real estate taxes, but when we talked about the Arizona property tax credit in a previous lesson, we said that you can't really go by this bill here because this is saying, well, in this case, it was the 2021 amount of taxes, but actually taxpayers pay those taxes in two installments, one in 1 year, one in the other. So, and not all taxpayers, some will pay the whole thing all in 1 year. I mean, it depends. So you need to ask them, how did you pay these? Now, a lot of taxpayers that have mortgage interest, they have an escrow account and their mortgage company is paying the taxes for them. And then it's very simple. They send them a form at the end of the year. We'll show you a copy in a minute, the 1098 that shows mortgage interest, and down there it'll say property taxes. But if they don't have a mortgage and they say, well, yeah, I just paid it when it was due. I mean, I don't know. That means they probably paid it in the two installments. And if they don't know or they can't tell you exactly, remember we had those screens where you could go log on to the treasurer site, or you have to find their parcel number and you can find the tax receipt if possible, if necessary. Okay. Yeah. Here's that. Here where you go do the parcel inquiry. We showed you this under the Arizona property tax credit lesson. So more taxes paid. So right here we say additional state and local income tax, right? Do not include the amounts from the W-2, 1099s, or W-2Gs, right? Those are the forms we input, and where it said federal income tax withholding, TaxSlayer already knows about those, so don't double count them. But here would be the case that maybe at the end of last year we filed their return and they owed something with their last year's tax return to Arizona. And that got paid in April of 2024. So then we would want to make sure we put that in there as additional taxes. There's also a place here to put in real estate taxes. And here it says personal property taxes, for example, car registration. But remember, we can only put the vehicle license tax, not the whole car registration in there. They can deduct sales taxes. Now, IRS has tables and they can use the tables, or if your taxes are higher than the tables, and usually most sites will have, like here we have in Arizona or in Maricopa County, we have a multitude of individual municipalities, like Peoria or Mesa or Glendale, and they all have different tax rates. And we can go in and we can put what zip code you lived in, how many days you lived in the zip code, what the local percentage was, what the state percentage is, and then TaxSlayer will calculate what's better from the IRS tables or better for that. Also, I mentioned earlier, what if you bought like a new car? So right here it says they also bought a new car last year and paid $1,565. You're going to put that under here, general sales taxes paid, and it will add it to the other sales taxes that are doing. Okay. As I said earlier, it's really rare that anybody would itemize deductions unless they have mortgage interest or they had a huge medical bill that wasn't covered by insurance. Okay. So this is the thing, but now here there's a couple rules about mortgage and interest. Okay. First of all, it can be on your first and second home. Most of our clients don't have two homes, but it's possible. They can deduct the mortgage interest on two homes if they have a loan. That second home could be a motor home, a trailer, a boat, and as long as it had sleeping quarters, then we could deduct the tax from that. I'm sorry, deduct the mortgage interest if they had a loan on that. Okay. Sometimes when you buy a house, you pay points at settlement. That's an amount of prepaid interest so that you lower your interest rate and then therefore you lower your monthly payment. So some people pay points on that, and those are deductible, in the first year. It'll come out on the statement, so you won't have to ask them about that. And then, as I said, we can also, usually the mortgage interest, um, most loans will have a escrow account unless you've paid down the loan enough and then you tell the mortgage company, I don't want you to withhold taxes and pay them for me. I want to pay my own. And that's possible, but most people don't go through that. Here was um, the exception to mortgage interest that I said I needed to let you know about. Many people, they have home equity lines of credit, right? A HELOC. And the interest on those can only be deducted if they use the funds to either buy the house, and sometimes that happens to where mortgage companies, they used to do this trick where they take out two loans so that on the first loan, it was below, they only funded 80% of it, and then they avoided something I'm going to talk about in a minute, which is mortgage insurance premiums, right? It was a trick. I haven't seen that too much lately, but sometimes that would be. So there in that second mortgage there, you're using that to fund the purchase of the home. That interest is deductible, no problem. Okay. Or if you're get a loan to put on an addition or remodel the thing or improve the residence, that's perfectly fine. But many years ago, we used to be able to deduct interest on our credit cards and auto loans and everything else. That went away. I mean, it's a long time ago, but went away a long time. But then people got in the habit of just borrowing money on their house, on the equity of their house, paying off their credit cards or auto loans, and then they could get a deduction. Well, the Tax Cut and Jobs Act, they cut that off and they said you can only deduct mortgage interest if it's used for these purposes. It's used for the purpose of buying, building, or improving the qualified residence. Now, mortgage insurance premiums, if you only put a smaller down payment, they charge you a mortgage insurance premium to make sure, so if you default on the loan. And those used to be deductible, but they're not deductible anymore. So it'll show up on that form, but don't deduct it. Okay? Yeah, so here's a copy of the mortgage interest statement, the Form 1098 right here. So box 1 will tell you the mortgage interest it received. It'll say when it was originated. See, this box might have something for mortgage insurance premiums, but it's not deductible. Here's where if they did have points, and that would usually be in the first year of the loan, you could put it there. In this case, here was the escrow account. and they said, yeah, we paid property tax on their behalf. And so here you don't really have to go look up the tax receipt and go on that. You can just rely on this for their property taxes, unless you need to be careful. Sometimes mortgage companies get bought out and they'll come in with two 1098s, and so you want to make sure you're or they refinance the home in the middle of the year. You want to make sure you're capturing all the property taxes. Okay. So here's the screen where you would put mortgage interest in. You can put real estate taxes in here. That's not, as I said, this PMI deduction is no longer deductible. It seems to come and go. I mean, they put it back in. You know, the mortgage industry's got a huge lobby, and they'll try to do it. They put it back in, then it expired, and they didn't renew it, and so right now it's not deductible, but it could come back. Can taxpayers? Okay, so let's look at gifts to charity. And you will get folks asking about this, I promise you. You know, they'll say, yeah, you know, I give at least $10 a week to those guys on the corner in the traffic, right? They're homeless, you know. You cannot deduct those. It can only go the contributions to a qualified organization. Sometimes you've heard them referred to as a 501c3. There's a list of them. You can go, if you're not sure, you can easily find that list. Just Google list of charitable organizations, and IRS has go to the IRS site, get the IRS list. There's also, if you're doing charitable work like you are, you know, you're doing VITA work, you could deduct your mileage if you were itemizing deductions. So you could get 14 cents a mile as a deduction for that. Can you take a deduction for a raffle ticket? Well, you know, you think, hey, that's to the church, but no, because you're really buying, uh, you're buying a hope that you're going to win something. You know, you could get something of value in return. So that's not deductible. And then I already talked about what that 60% limit is, but trust me, that the folks we're dealing with, they're not giving away 60% of their income. I mean, you know, most of these folks are trying to just pay rent and food and get by. Okay. This is the screen where you'll give gifts to charity. This is for cash gifts to charity. You'll see another one where you have non-cash gifts to charity. You know, you give stuff to Goodwill or St. Vincent de Paul or something like that. But be careful here now. Now, I didn't discuss this when we talked about out of scope, common out of scope items, because this can be a common out of scope item. If they're non-cash donations, you know, goods, are more than $500, they have to file a special form with a lot of information, and we do not do that. It's out of scope. We have to refer them to a paid tax preparer. Now, when they come in and maybe they say, I got $1,000 worth of non-cash goods, I wouldn't immediately turn them away, because you might want to kind of look at facts and circumstances. And, you know, we can deduct $500 of non-cash, so maybe they would lose a $500 deduction. Now, if they're only in a 10% tax bracket, that means they lost $50. Well, if they go to a paid tax preparer, what are they going to charge them for the return? So they may just decide to just claim the 500. They don't have to claim all of it. So keep that in mind when you're doing the tax returns for these folks. Okay. So when you put in cash contributions, it doesn't show on this screen. You can put in individual ones like tithes to church, you know, how you paid for it. If you've been paying for it week by week, right, just put in one amount for the year and put in the date of the donation is the last day of the year. There's also a tax layer screen that allows you to just lump all of the cash contributions together and put in one number for that, which is fine. I just make sure that the taxpayer understands the rules, that they've got to keep documentation of these contributions in case they get audited. We don't need to see that. Okay, we take them at their word, but I always remind them that they're responsible for what's on this return whenever they're giving us this. Okay, so these are You can add them in individually, like here they put in tithes to church, American Cancer, Millsap. I'm going to reemphasize something here. Even if they are not itemizing deductions, enter in their charitable contributions unless they're going to use that to take a credit on their Arizona tax return. Then you wouldn't enter that here. But you want to enter in all the charitable contributions because, like right here, what is this taxpayer? 17, 19, 20. They got $2,200 of donations. They're going to get an extra 33% added to their standard deduction on the Arizona return. And so when you enter them on the federal, it carries over to the Arizona return. Okay, here's where you can click on non-cash gifts to there. And again, these are less than or equal to $500. Don't put more than 500 here. It would be out of scope if it was more than 500. Okay. So I just alluded to this, that taxpayers have to have receipts and records of all their contributions. Now, and that can freak some people out. Well, I didn't get a receipt for that. In fact, the charity doesn't have to give you a receipt unless it's $250 or more, but you need a record. That could be a note in your calendar, right? Or, if it's a canceled check, that works fine. If they do give you a receipt, that's work fine, but you need some kind of receipt. Now, if it's more than $250 or more, the charity has to give you a letter, and the letter has to say, here was the total contribution. And if maybe you got something back in return for that, the letter has to say that. And that part's not deductible. Let me give you an example. You go to a dinner for United Way, it's $200 a plate. They're going to send you a letter. Hey, thanks for your $200 contribution for the dinner you went to. And by the way, the value of that dinner was $50. So now you only get to deduct $150 of that. So be careful about that. Non-deductible items, the cost of raffle, bingo, or lottery tickets. Yeah, no, you can't deduct lottery tickets. Can't deduct tuition. Here, now a lot of people will think of that. Yeah, I donated a lot of my time at St. Mary's Food Bank, right? Unfortunately, you can't deduct your time. You can't deduct blood donated to it, but people will ask you about that. Other things, you can't deduct card depreciation for performing services. However, as I mentioned earlier, you can take a 14-cent per mile deduction. Anything to do with depreciation, we never do anyway. Okay, you can always keep that in mind. Direct contributions to an individual. Now, here's one that's coming up common. Somebody's house burns down or whatever, and somebody sets up a GoFundMe account to help them, right? It's kind of common these days, and you go help them. That's not a charitable contribution. It has to go through an organized charity. So contributions to individuals are not that. Sickness or burial expenses are not deductible. And again, this was the part of it, and this applies to anything. The part of any contribution that personally benefits you, unless it's what we call de minimis. KJZZ might give you a tumbler or something for your donation. That's kind of de minimis. You don't have to reduce it by that. But if you got a $50 a plate dinner, or you got tickets, you contribute to the ballet, and because your contribution is more than a certain amount, they give you some free tickets. You've got to deduct the value of those free tickets that you personally get. I've said this 2 or 3 times now, probably warrants it again though, but charitable contributions that are not used for the Arizona tax credits should be entered in the federal section of the itemized deductions menu. Okay. So here's the screen where you would enter cash gifts to charity. Here is an example of you've entered in 3 of them for $1,500. Now here's what I'm going to show you here. Here would be, now this was last year's, this is the federal return, page 2 of the federal return, where it shows you got a standard deduction of $12,950. Now this year I think it's $14,100, right? This is a single person. The Arizona standard deduction is exactly the same as the federal standard deduction. But let's look on the next page what happens on the Arizona return. So here they've got some adjusted gross income. Look, here's their standard deduction. But it says down here, if you checked box 43S, that's this box right here, and you claim charitable contributions, check here, complete page 3, and you can see they got an additional $405 deduction right there. That's so page 3 is going to say, okay, well, here are your total contributions, right? And by the way, this 27% is now 33% that they would give you as an additional standard deduction. Okay, that's all you need to know about itemized deductions. Now, health insurance. Okay. And specifically, we're talking about Obamacare, but the official name of Obamacare is the Affordable Care Act. You may have heard of it of other names. You may have heard of it, as the Marketplace, or like say Obamacare or something. There's another term, I can't think of it right now, but we had a problem last year with this because a lot of people would come and there's a question on the intake form. Last year it said, did you have insurance under the Affordable Care Act? They don't even know what the Affordable Care Act is. And they say no. But then if you sit down with them and you say, well, hey, did you buy insurance through the Marketplace or buy Obamacare? Oh, yeah. Well, if they did, they have to bring us a form, a 1095A. Let me just give you a broad overview before we get into the slides. Here's the overview. You go apply for insurance through the Marketplace at the beginning of the year, and they ask you, well, how much are you going to make this year? Now, nobody knows exactly. I mean, they know what they made last year, and they'll estimate it, usually probably based on last year. But things change sometimes during the year, and they will tell you if something changes in your income, notify us. However, most people forget about that, and they don't. So anyway, they tell them, look, yeah, I'm going to make $15,000 this year. Well, then the insurance agent figures out, okay, here's what your premium would be normally. But now because you're only making $15,000 a year, the government's going to subsidize and pay a part of that premium for you. But now at the end of the year, see, that was just an estimate. Now at the end of the year, we got to look and see what you really made and then recalculate what that subsidy should be. And it results sometimes where, let's say in the middle of the year, they got a better paying job and they're now making $30,000, but they forgot to tell the insurance company. So at the end of the year, their income was a lot more than $15,000, and therefore their subsidy should have been a lot less. And now they got to pay some of it back. And they're really surprised. On the other hand, maybe they lost their job in the middle of the year and their income's lower than what they said. Well, then they're going to get more subsidy and they'll get a higher refund back. So now that you have that overview, let's look at what happens here. Whenever they bought insurance through the Affordable Care Act, they have to file a Form 8962. This is that reconciliation form that I was just telling you about. Now, the Affordable Care Act, when it was first put in, told us insurance was mandatory and you would receive one of these 3 forms, like one's for the employer showing how much insurance you had, or if you bought it yourself, right? Proof of insurance. Several years ago, during the first Trump administration, he gutted that requirement. You don't have to have insurance, but it didn't change the Affordable Care Act. So these employers are still sending these out and they'll bring them to you. They think it's necessary, right? And when you look at that form, a 1095C, employer provided, just give it back to them and say thanks and put it back in their folder because it has nothing to do with this year's tax form. However, this one does, the 1095A right here. This is health insurance marketplace statement. And we need this to be able to do their return because down here under the bottom, it's going to say who's covered and it's going to tell us how much the subsidy was. And we need that form to be able to do that reconciliation. Okay. So when you're preparing the return, you go through and you put in all the income and all the deductions and all the credits and everything. You get done towards the end. And when you say continue, this is the last question you're going to get. Did you purchase health insurance via, oh, here was the other term I was trying to remember, healthcare.gov or a state marketplace, you know? And if they said yes, and you finally, you need to ask them, be sure. We got more rejects because of it. Two biggest reject reasons we got last year was this Affordable Care Act form and IP pins. And we'll talk about IP pins in a minute too. Okay. So here we say yes. And when we hit continue, it then asks you, it'll show you the dependents you've got listed. If you have additional family members that are neither a spouse or dependent, click here. But I believe that gets to be out of scope. Usually it's not going to be um, that more. But if maybe for some reason it says on the form that there was somebody else you were covering and you maybe forgot that as a dependent, you could go back and add them. Hopefully by now you've entered everything. So and now you could, there's a place that says you could override family tax family size. That's out of scope. You're not going to want to do that. Okay. And sometimes here's what'll happen is, you know, part of the year they paid for the insurance and part of the year they were at their lived with their mom and they paid for part of it. That gets too complicated. We can't do that form where we have to allocate between the two. So, but here's the normal thing that you're going to see, right? And you'll hit continue, okay? And then it asks you these questions. This is really kind of a complicated question. And as it says, in most cases, the answer is no. Only answer yes if you were considered lawfully present in the US or you meet the health coverage tax credit criteria. And I have never seen one of these. So, and by default, it's no. Okay. Um, then this is important, Ryan. It says, do all forms 1095A include coverage for January through December with no changes in monthly amounts? Now, here's how you can see a copy of that 1095A is, I believe, in your test booklet in the 6744, advanced scenario 9, I think it's Jose, I think he had a 1095 Affordable Care Act. And they're list out by month what the premium was, what the premium is for this special plan, and what his subsidy was. There's 3 columns. And it'll list it January through December. This question is saying if there were no changes in the monthly amounts, if they're all the same every month, click yes. And then when you click yes, all they're going to ask for is the bottom number, the total, and it'll say that it's on line 33A. And in your test question on this one, that's the case here. You don't have to enter in month to month. But in real life, they'll come in and they'll say, well, yeah, I didn't get insurance until June, right? So when you get that form, it's going to have blank months and you're going to have to go enter in the individual months. Or maybe they got hired at a job and they only had insurance the first 3 months of the year. So then you're going to get this form. If you don't click that yes in that box, the first one, then you're going to get where you have to put in exactly what's on the 1095A form in here. And then the tax layer will calculate everything. This is the reconciliation. If you have more advanced payments of the tax, that's the subsidy I was talking about, than what you qualify for. In other words, you overestimated your income when you applied for the insurance, right? I'm sorry, you underestimated your income. Your income's higher, so you don't qualify for as much of this, then you got to repay it. On the other hand, if you had made less advance payments, then you're going to get a credit. You'll receive a credit or an extra refund for the difference. And by the way, it's called the premium tax credit, PTC. Sometimes they confuse that with the Arizona PTC property tax credit. This is called the premium tax credit. And you'll get a credit. It is a refundable credit. Okay, so even if you don't owe any taxes, you're going to get a refund for this. Okay. Yeah, so in this case, this is a screen they put in the amounts from the 1095-A that was there, and then the software has calculated the refund for you. Okay, so after you finish this health insurance, it will say, hey, your return's complete. Do you want to add a state? Now, in reality, now Practice Lab has not added states yet. They will by about the end of December, I think. But in general, when you get into a live site and you're doing it and you finish this part of it, once you put in the state in the basic information, it assumes that's your resident state and it will automatically create an Arizona return. If it doesn't, you can say add a state return. It's possible, not likely, and especially if you're new, it's, you know, the site coordinator, it's possible if they moved in here, we may do a state return, you know, a partial, a part resident return or another out-of-state return, but most VITA sites don't get into those get kind of complicated, and it depends on the site coordinator and it depends on the partner whether they allow that to happen. And especially if you're new, you're not going to do that. Okay, let's talk about other payments and estimates. Now, sometimes, not many of our clients, but sometimes, like say if they're self-employed, you know, if you work for somebody, they're withholding taxes out of your paycheck. So you, towards the end of the year, you know, you've probably paid all your taxes and maybe you're getting a refund. At worst, maybe you got to write a check for a little bit, but you're pretty much, you know, if you get your withholding right, you know, you're okay. But what if you're self-employed? Nobody's withholding taxes on that. And IRS says, well, you still have to make quarterly estimated payments. And if you don't make them, then we're going to penalize you at the end of the year. If you have enough tax liability and you didn't make the estimated payments. So if they come in and they have made estimated payments, you're going to go into this screen, and those are based on quarters. Okay, the first one's due April 15th, then June 15th, then September 15th, and the last one is due January 15th. Okay, that could be for both federal and state. Okay. Here, if for sometimes maybe they've got a refund coming and they want to say, well, look, you know, hey, I just started this job and I know I'm going to owe some additional taxes. So let's just apply my refund to next year's taxes. Then we could go into this screen and do this. If for some reason now we have a self-employed individual and maybe we recognize that they're going to have a penalty or that, we can print vouchers for them. The software will calculate the estimated payments based on this year's return, or we can override it and say what we want to do, you know, how much they want to pay each quarter so that they don't get stuck with a big bill at the end of the year. So if they're making estimated payments, when you go into that payments estimated payment screen, if by chance, go look on their tax return for last year. Maybe they said, oh yeah, I got a refund, but apply this to the next year. You're going to want to put that in here. And then they're going to tell you, yeah, I paid the first quarter here, second quarter, third quarter. We'll put those payments in. Okay. This one, as I said, you can ask the taxpayer if they want to apply a part or all of their, you don't have to apply all of their refund. They can apply a portion of it if they want to it. Okay, let's talk about some miscellaneous forms. Okay. First of all, when you get into the screen, I showed you on that main screen that there was a place for miscellaneous forms. Okay. And the first one is injured spouse. Well, I've got some slides. I'll talk about that. Most of these we're not going to do. I'll talk about the application for extension. We don't do very many of those. Okay. We cannot do married filing separate allocations. This one we do. Now, usually this form, we put in the basic information. They've got a shortcut to this form under basic information. And as I told you earlier, This is one of the biggest rejects we get because many people don't realize they've been assigned an IP PIN. See, this instruction here says PIN needed if you were issued a CPO-1A notice from IRS. And so there's been so much talk about scams and people doing things. So people will get this letter that says, hey, we've issued you an IP PIN. And they're saying, huh? I didn't have any identity theft problem. This must be a scam. And they throw the letter away and they forget about it. But then they come in and there's a question on the intake form. Hey, were you issued an IP PIN, an identity protection PIN number? And they'll say no, because they don't really know. And we file the return, it rejects. So all of us, we really need to make sure that that hasn't happened to them. Sometimes what happens is they have some kind of identity theft that gets reported to IRS, or somebody tries to use their social security number and file a return, and maybe they never even knew about it. Maybe IRS rejected it, whatever, and realized that this was some kind of fraud. But now they flagged your account. They sent you a letter saying, hey, when you file your return, you're going to need this PIN number. And it changes every year. Okay. So if you didn't enter it in their basic information, you can enter it here. We'll talk just for a moment about the Form W-7, which is an application for an ITIN. I've got a whole separate video on ITINs, so I'm not going to talk much about them during this video. Okay. But we'll get to that in a minute. Most of these others, you're not going to do anything. So let's talk about injured spouse. Okay, so what is an injured spouse? That would be, let's say, here's one example, a common one that I see. A couple gets married and the husband from a previous marriage, he owes child support and alimony and stuff to somebody, and he hasn't paid it. They complained to IRS, and IRS started attaching his refunds. Now he gets married to you, right? And you file a joint return. Guess what's going to happen? They're going to attach your refund. Well, if you were the injured spouse, in other words, you had nothing to do with this. This happened way before you even got married. They should not be taking your refund. And in fact, this is one of the big reasons people will come in, say, hey, we need to file married filing separate so they don't attach my refund, right? Because he's got a debt, right? But we can file an injured spouse form. I'm not going to go into a lot of detail. And if you ever get into something like this, get your site coordinator involved because we can help them with this. This is probably better than turning them away, saying we can't do a married filing separate return. They can do a married filing joint return, file this form, and that way it protects the innocent spouse. In fact, we've kind of gotten, I'm surprised they still say injured. Usually we say innocent spouse, Okay. Application for extension, Form 4868. We generally do not file these for a couple reasons, okay? And plenty of people, they just haven't gotten all their forms. They lost their W-2, their employer they can't get in touch with for a variety of reasons, right? They come into our site on April 10th and we say, hey, look, you can get all of these credits and stuff like that, but you need to go figure out the documentation, and they can't get it done before April 15th. The reason we usually don't file extensions is because we file extensions for these folks and then they don't come back to us, or we've closed down the sites. We've only got a couple of sites that are open during the summertime or during the off season. And so we end up with these straggling returns out there, right? Instead, usually what we'll do at a site, the extension is really simple. It just asks like 3 questions. And we just print them out. We give them to the taxpayer, say, here, mail this in, and then come and see us, during the year. And that way we don't have these returns in here. But once in a while, let's say it's, a returning client, that they're going to come back, you're going to do it. You may want to file this extension. If you do, there's 2 things to really remember about this. One, people think, oh yeah, man, I'm going to owe some money this year. Well, I'll file an extension and I'll save up my money so I can pay for it later. Well, if they do that, they're going to get penalized because even though the extension is just an extension of time to file the return, not an extension to pay. And if you think you're going to owe, you should be paying money with the extension just to save yourself penalties from doing it. The other thing about these forms is they still will have to, if we file an extension form, we can e-file it for them. They need to sign the 8979, which is the permission for us to file electronically. They have to sign that. Okay, so here's that IP pin screen I was telling you about, because, and I'm going to talk a little bit more about this, right? And it can be sometimes not only for the taxpayer or the taxpayer spouse, one or both. It could also be for the kids. Okay, you need to ask them about this. I've already talked about one case where, maybe their identity was compromised and somebody noticed noticed, or IRS noticed it and mailed them a letter. Probably 2 years ago, IRS opened it up to anybody who wants to enter this program and have an IP PIN required for their return can do that. I did this because I've been a CPA for 30 years. Used to be way back when we put our social security numbers on the returns. I have thousands of returns out there with my social security number on it. So as soon as I could do this, I applied for an IP PIN. I have to have an irs.gov account. Some people have done that. Now, I'll just tell you the personal story that happened to me. I did it the first year. A couple weeks later, I got one of those letters. Oh, here's your IP PIN to file. Oh, good. I put that away, filed my return. Everything was great. Next year, this was last year, I go to file my return. I forgot all about that IP PIN. Put in everything in, I file it, rejects. Oh, we need an IP PIN. I said, oh, yeah. Where's my letter? I didn't get a letter. I had to go back onto irs.gov and go into, then I can retrieve my IP PIN. So I had to manually go get it the second year. Okay, so we may run into some of those too. Okay, so just to give you a heads up on that. Okay, we have the ability to apply for an installment agreement on behalf of the taxpayer. They're applying for it. We can fill out the form for it. If they end up with a balance due, I generally do not want to do this. Okay, here's one reason. If they've already got a payment plan and they say, oh yeah, I can't pay this. And if I offer to do the payment plan, yeah, okay, do this. And I put it in, then they forget it. A, if they already had one, then the return's going to reject. B, by the time they got to start making payments, they forgot all about this. They don't really know. If on the other hand, they have to go set it up, then they know exactly what they have to do. So usually I will tell the taxpayer, look, you owe $1,000. You should pay as much as you can with this return by the due date, because that'll save you interest and penalties, right? So say you owe $1,000, send them 200. They're going to send you a bill. It says, hey, you owe us $800, right? And it'll say, if you can't pay this, call this number or go online and you can set up a payment agreement. But that way I make them do the work, and then they're going to remember that they have to make this payment agreement, because once they start that, IRS will get really serious about collecting this. So if we do it for them, they just may forget about this. On the other hand, maybe they just need help. And if you want to, you can help them. We can go in here and we can establish a payment agreement for them. Okay, ITIN applications. Earlier in one of the other lectures, I discussed about ITINs and when you would need an ITIN and all of that. So I'm not going to repeat all of that here. I have put in the playlist of all of these returns here. I had another video that's detailed, perfect detail on ITINs. What I had told you earlier, and I'll repeat here, somebody who needs an ITIN on there, we can help them with that. We're going to fill out a W-7. We can do this in TaxSlayer, but there's a lot of paperwork that has to go with that, like copies of their passport, and those have to be certified copies, which takes some effort. There's a couple of us within Maricopa that can certify those, but usually you will refer them to those sites. so that they don't have to, IRS will say, well, you have to either send your original passport or a certified copy. I would never send my passport to IRS. Not that they would intentionally do anything wrong, but they're slow in processing things. You might need that for other purposes. If it gets lost in the mail, I mean, you know all the reasons why that would probably be a bad idea. But so then they've got to get certified documents to do that. You have to mail these returns. You can't e-file them. So generally, we're going to tell you to refer them to a site that has experience in doing these returns. So here in a live session, I would go through some of the things, but if you're interested in this, there's another video that says ITIN stuff. So watch that video if you want some more details about how this works. Okay. Any person listed on the return that's applying for an ITIN, we've got to paper file these returns. We can't e-file them. Always get your site coordinator involved. So with that, that's all I'm going to say about ITINs in this video. As I said in another video, I kind of gave a little bit more explanation of who would need them and when you would need them. Okay, so other taxes. Self-employment tax, we talked about earlier when we talked about business income. Most of these are all out of scope. For instance, alternative minimum tax. Trust me, you don't want to mess with that. And our clients are never going to be subject to that. We already did talk about tax on early distributions. Okay, and on your IRS exams, on the returns you have to do, you've got a couple of examples of that. There's something called a first-time home buyer's repayment, but I'm not going to go over that because most of that they've had to have repaid it. It started in 2008, and I think by 2023, that's the last time that they could have made a payment. We should never see those again. If for some reason you do, get your site coordinator involved, and we'll figure out how to help them. Okay? So self-employment tax is auto-calculated. Remember, just to refresh you, if you're self-employed, you have to pay income tax on your net earnings, after expenses, but that you have to pay regular income tax, but then you have to pay self-employment tax, which is Social Security and Medicare, 15.3%. When you prepare the Schedule C, the business return, whenever there's self-employment income, TaxSlayer is going to calculate that 15.3% tax. It'll automatically calculate it from that. There's also a deduction, and I didn't go over this. It's actually an adjustment, not a deduction. It's an adjustment for 1/2 of whatever self-employment tax is. That's because earlier I kind of told you when you work for an employer, you're paying 7.65%. You can look at your pay stub and you can see that comes out. And then the employer matches that. Now the employer gets a deduction for contributing to your Social Security. Well, if you're self-employed, this is their way, by giving you 1/2 of the self-employment tax as an adjustment. That's a way of giving you, the employer side of you, the deduction for having to pay that tax. So it's an adjustment that goes on Schedule 1, and TaxSlayer automatically takes care of that. Tax on early distributions, that's that 10% penalty if they take an early distribution from a retirement account. We've already done that. You're going to be doing, there's a couple of problems in your tax returns that talk about that. So I'm not going to belabor that too much. Okay, except to just remind you about there are exceptions to that penalty. When TaxSlayer will auto calculate the form 5329, but it's going to ask you if they had any exceptions to the penalty. Remember these exceptions? We told you the main ones are higher education and first-time home purchase, but we added 2 more this year. Remember, for $1,000 for emergency expenses or $10,000 for domestic abuse. Those are 2 new for this tax year. Exceptions to the 10% penalty. Okay, so here we've done the homework 5. Now by now, I'm sorry, we finished session 5 here, and by now you should have everything you need to know to be able to finish the tax returns. So before we get into there's one more session that talks about some miscellaneous things of VITA, but by now you learned everything you need to be able to finish those tax returns and answer all the questions in the test booklet. I'll go over a review of some of those or some of the more difficult ones. I think I've told you this, but I'll repeat it again just in case. The scenario 7, 8, and 9, where you prepare a tax return. You know, some of the questions that they ask you, you could probably go figure out without preparing the tax return. I really suggest you don't do that. And I'm like, one of the questions says, well, what was the total amount of withholding? Well, you could go back in the forms and get a calculator and add them all up, but you may miss one. It's best just to do the accurate tax return. It's good practice for you too. And then once the return's done, you print out a PDF of it and you answer the questions from the tax return. It'll say, what's the amount on Schedule 1? Something like that. Go to Schedule 1, look at the line, and put in the number. That's my advice. A second piece of advice that I have that's really important, and I haven't gone over this, is, and in fact, I'm going to put the video on pause here. I'm going to stop sharing. I'm going to pause the video and I'm going to come back and show you the 6744 booklet. So we're going to talk about a couple of strategies. Okay, so now I'm going to share the 6744, the test booklet right here. Okay, so I'm going to go back up to the top here, page 75, which was, we have our advanced scenario questions, right? You're all really familiar with this by now. Okay, so this is the advanced course scenarios and test questions. What if, remember I told you when taking this test, you can take it once and you have to get 80%, but if you don't get 80% on it, you get a second time. Now watch what happens here. I'm going to scroll down to the end of this, or you could go up to the table of contents, either way, but there's a retest that they would give you. And they give you the retest questions in here too. And my suggestion to you, okay, I'm almost there, hold on. Good. So, right, this starts on page 116. It has the advanced course retest questions. Now, we're going to look at just a couple of these and you're going to say, hey, these look like the same thing I took in the test. They are. They're basically the same thing. They just revise how they ask the question. You know, some might be true and false. Some might be multiple choice. Some might be fill in the blank. Some might be multiple choice. And you don't have to create different tax returns. It uses the same tax returns. Okay. But my advice to you, don't go directly to Link and Learn and take the test. Take it in the booklet. Circle in your booklet in pencil what your answers are. Okay. Then secondly, take the retest, because sometimes you'll be taking the retest and like in the original test it said, oh yeah, write in the withholding, oh, $300. But in the retest it says, which one of the following represents the withholding on that return? A, B, C, or D, and you don't see 300 there. Wow, you probably did something wrong on the first one. So it cues you to go back and look at some of these. But so look at advanced scenario 1. This was the one, child Lee, what was, okay, this was about dependents and the earned income credit. What's the most beneficial allowing filing status that Sharon can claim? I think in the test question it says, oh, she can claim head of household, right? Now this one is saying, well, make a choice, but it's basically the same question. You know, it says, does she have to report her gambling winnings? I forget how they asked it, but do you see what I'm saying? So go answer both the test and the retest. One might give you clues into the other. And then when you've got this all done, then you can go to Link and Learn, do it. When we start session 6 next time, we're going to talk about a few other things at VITA sites like facilitated self-assistance and how you do your volunteer agreement, but I'll also do kind of a final review of the test. And if you've completed the test before then you'll have a real good idea of what I'm talking about. Okay, so with that said, this will end session 5, and we'll pick up with the last session, session 6, on the next video. Okay, bye-bye.